This is the TradeRobotX's cross-asset macro brief for Tuesday, March 24th, 2026. So for today, our focus is pretty clear. We're going to start with the macro anchor, which is oil. Then we'll trace that all the way through the inflation transmission chain. We'll take a look at financial conditions, read what the market signals are telling us, especially from gold and Bitcoin. And from there, we'll lay out the two most likely paths forward and wrap up with the key levels you need to be watching. Okay, let's start with the macro anchor, oil. Markets are still being pushed around by headlines from the Middle East, and that makes oil the absolute center of gravity right now. Everything else is basically just reacting downstream from there. Right, and if we look at Brent, it's sitting in that $100 to $105 zone. Now, it did rebound more than 3% today. That's really just renewed geopolitical caution, walking back some of yesterday's pretty sharp de-risking. And it's really important to think about this in terms of price zones because they really do define the market regime. As long as we hold here in this $100 to $110 zone, things will stay volatile, sure, but they'll be contained. The real tripwire, though, is a decisive move above 110. If that happens, you're going to see a very broad, very quick macro repricing across the board. Okay, so that brings us to the inflation transmission chain. This is probably the most critical part of the analysis right now because the path from what's happening in energy to what's happening in risk assets, well, it's incredibly clear. The propagation is really straightforward. It all starts with energy prices, right? That feeds directly into inflation expectations. And of course, that's what central banks are watching, so it influences their policy. And that policy, in turn, is what drives bond yields, which is the next key variable we need to look at. And yields are definitely proving to be sticky. The 10-year U.S. Treasury is sitting in that 4.35 to 4.40% area. What that's telling us is the market is pricing in a delay to that disinflationary trend we were seeing. So the crucial point here is how these different yield levels impact risk assets. Right now, we're in the baseline higher for longer zone. But once yields start to move above 4.5%, that's going to act as a serious governor on equities. And if you see a move above 4.8, well, that's when the market starts to price in the potential for real systemic stress. And this really highlights the bind that central banks are in. You have this classic stagflationary risk. Energy shocks pushing up inflation while growth concerns are lurking. And that environment just reinforces the higher for longer base case for policy. Really, any talk of meaningful easing is off the table until we see clear stabilization in the energy markets. Okay, so this brings us to the next link in that chain, how all these dynamics translate into broader financial conditions. And the main vehicle for that, of course, is the US dollar. You have to think of the dollar as the global liquidity valve. Right now, the DXY is trading in that 99.10 to 99.50 range. And just like with yields, these DXY zones are absolutely key. Below 98, that's easier global liquidity. Between 98 and 100, conditions are more neutral, maybe mildly tight. But that break above 100, that is a clear signal of a tight global liquidity regime. And this all flows directly through to equities. Right now, stocks are entirely macro-dominated. This isn't about fundamentals or earnings stories. And so the key triggers for a deeper repricing are those macro levels we've just discussed. Brent breaking above 110 and the 10-year yield pushing through 4.5%. Okay, next up, let's look at a couple of high-frequency indicators. These can give us a really good real-time read on market sentiment. So, first, gold. It's still looking pretty soft, trading around that $4,400 area. Now, you'd think geopolitical risk would be providing more of a bid, and it is providing some support, but the dominant story here is the pressure from those elevated real yields. And frankly, until yields stabilize, gold is probably going to remain capped. And then there's Bitcoin, which continues to be an excellent real-time gauge for global risk sentiment and liquidity. It really is the canary in the coal mine here. It tends to move well ahead of equities. Let's break down the zones. If you see it trading above 70,000, that tells you liquidity is intact and there's a risk-on bias. In this zone between 67 and 70K, things are more neutral, but we'd call it fragile. But a clean break below 67,000, that would be a clear signal of systematic de-risking across the market. All right, so let's pull all this analysis together. We really see two distinct macro paths from where we are now, and each one has a very clear trigger. So path A is what we're calling the inflation shock. This gets triggered if Brent moves above $110. The domino effect is clear. higher yields, a stronger dollar, and weaker equities in crypto. Path B, on the other hand, is the risk premium fade scenario. This happens if Brent falls back below $95. And in that world, you'd see stable yields, a cooler dollar, and a pretty decent rebound in risk assets. And this brings us right back to that propagation order we mentioned. It's so important because the shock moves through the system in a very consistent way. It always starts with oil. From there, it goes to Treasury yields, then to the US dollar. Then you see it hit gold and Bitcoin, and the very last layer to react is usually equities and credit. Understanding that sequence is absolutely paramount right now. So finally, let's distill all of this down into a few actionable guideposts. These are the key numbers that you should have on your screen for the rest of the week. The thresholds are very clear. For Brent, that shock level is 110. For the 10-year Treasury, the equity pressure point starts at 4.5%. For the DXY, the key tightening threshold is 100. And for Bitcoin, that de-risking signal comes on a break below 67K. So, the key takeaway is this. The market isn't in full-blown crisis mode, not at all. But it is actively pricing in two things: a geopolitical energy premium and delayed monetary easing from central banks. And mastering that transmission chain we've laid out, from energy to inflation to yields to the dollar and finally to risk assets, that remains the absolute key to navigating this environment. That concludes our briefing for today. Be sure to follow TradeRobotX for daily macro updates.